Welcome you all for the course Banking Theory Law and Practice. The topic of this session is the lending, banks lending part 2. As we have seen the part 1 of lending earlier, we are going to see the forms of lending, the evaluation process of loan application and all in this particular topic. That's why it is termed as lending part 2. Let us see what are the forms of lending now. Lending is made by commercial banks in different forms. These include loans, cash credit, overdraft, bills purchased and discounted, etc. The banks provide advance generally for a short term as they cannot afford to lock up their funds for long periods. Moreover, a large portion of their funds constitutes short period maturing deposits. Advances are usually granted against tangible security or in special deserving cases on an unsecured, clean basis. There are different forms of advances granted by a banker. That's what we are going to see now. Number 1 is call money or short period loans. What is call money? What is short period loans? The call money or short period loans are the types of loans provided to businessmen for extremely short periods of time. For instance, these loans may be given for a period of a day or 2 days or at the most 15 days. It is for this reason that these loans are called call money. A distinct feature of this lending, particularly you should understand, the feature of this lending is that the bank can recall the loans without giving any prior notice to the borrowers. And if the loans are not returned in time, the bank can compensate itself by setting off the securities pledged with it by the borrower. The call loans are mostly extended by one bank to another to meet their short-term requirements of cash. The loans carry very low interest rate, and besides this, the businessmen, the brokers, middlemen and discount houses also take these kind of loans from bank. The high liquidity nature of the loan gives the banker the twin advantage of liquidity as well as profitable use of funds, thus bringing together a sizable income to the bank. Once the bank proposes to earn an income, it has to go for the call money and short period loans, which will fetch the benefit of the banker. This way, the call loans are considered better assets than the cash. That's why these are the loans that are provided to business people for short periods of time. Let's see, the second form of lending is loans normally. A loan is a type of advance which is granted by a banker, whereby the entire amount is paid to the borrower in one lump sum and at one time, either in cash or by transfer to his savings or current account. And no subsequent debit is ordinarily allowed except by way of interest, incidental charges, insurance premiums, expenses incurred for the protection of the security, etc. The repayment happens usually by installments. Interest is charged on the loan outstanding. No checkbook is issued under this kind. The type of security, you know that the type of security may take the form of personal security or shares of the borrower, debentures or government paper, immovable property or fixed deposit receipts, life insurance policies, or any kind of goods available with the borrower. These are all the forms of securities for availing this kind of loans. So that the banker allows the borrower to have the loan under this scheme, normally loans, but against some of the properties or some of the securities. That's what we need to understand. The normal loans are given, normal loans are provided to the borrower at a normal rate of interest or the specified rate of interest, taking some kind of securities from the borrower. This is what we should understand here. And these loans are a type of advance granted by a banker, and repayment happens usually by installments only, not renewal. Let's go for the next form of lending, that is known as overdrafts. A fluctuating account that indicates the aggregate amount by which a depositor has overdrawn the account is known as overdraft. It is available to the current account holders of high standing and normal integrity. The arrangements that enables a customer to draw over and above the balance standing on the credit of the account actually. This is allowable and allowed to the customers, those who are having the current account normally and who could avail even above their minimum balance what is required to be kept, or even zero balance they may be availing this facility, but provided that should be quoted in an agreement between the banker and the customer. And the above balance standing on the credit of the account, the banker insists on securities such as shares, debentures, government papers, life insurance policies, etc. Besides, personal security plays an important role in the extension of overdraft facility. Once you go for overdraft facility, besides personal security that plays, besides all those things, the personal security that plays an important, predominant role in this case. An overdraft facility is allowed for current account holders only. Accordingly, where a customer has a credit balance of rupees 8,000 in current account, and if there is an overdraft facility sanctioned by the banker of the order of rupees 7,000, it is possible for the customer to draw a check for an amount of rupees 15,000 and opening of a formal current account that precedes the opening of an overdraft account also. In this case, a checkbook is issued in an overdraft account. There is no restriction on the matter of withdrawals that can be made from this account. That's why it is the fluctuating account that indicates the aggregate amount by which a depositor has overdrawn the account, and overdrawn the amount from the account is known as overdraft. The customer is permitted to make any number of drawings, any number of withdrawals and repayments as desired without exceeding the overdraft limit sanctioned by the banker. The security in an overdraft account may be either personal or tangible. The tangible security may be in the form of shares, government paper, life insurance policies, fixed deposit receipts, etc. So that it is another form of lending by which the current account holders especially may be drawing some amount even though they don't have any balance on account from the banker, avail this facility, use the funds and repay in time so that it will be the benefit for the business people. Let's see another form of the lending that's known as the cash credit. Understand this? Cash credit. It is a credit given in cash to business firms. Normally, it is a credit given in cash to business firms, industries, and corporates. It is essentially a drawing account against credit granted by the bank. It is operated in the same way as a current account on which an overdraft is sanctioned. Overdraft is sanctioned. The borrower has an option to operate the account. Borrower is allowed by the banker to operate his account within the stipulated limit as and when required. And cash credits are generally allowed against the pledge or hypothecation of goods. Of course, against book debts or personal security, the cash credits are allowed by the banker, provided by the banker. A cash credit account is allowed on a continuous basis for years as there is a good turnover and both in the account as well as the goods and there are no adverse. A cash credit is distinguished from an overdraft. Cash credit is different from in that the borrower is permitted to withdraw cash from the account. In the case of cash credit facility, the borrower can withdraw only through check. Overdraft can be availed only through check, but from cash credit facility is available. And cash credits are ordinarily allowed against pledge or hypothecation of goods, personal security. With the periodical review and with the favorable factors, a cash credit limit for years together if there is good turnover both in the account and in the goods. However, an important difference between overdraft and cash credit accounts. Overdraft system, the amount of the loan is credited to the account of the borrower. Hence, the overdraft facility only to the depositors of the bank. So, only the depositors can avail. So that if open current account is expected to deposit some amount. As against this, the amount given by way of loan under the cash credit system account of the borrower. On the contrary, quite contrary, a new account is opened in the name who is allowed to withdraw from time to time small amount of money up to the prescribed limit of whole. This is one more point. Understand? These are allowed against security. Otherwise, it will not be allowed. This is what the nature of the cash credit. Another form of lending now. The another form of lending is let's see the clean advances now. Clean advances are essentially unsecured advances. A banker extends credit facility for a short period after taking into consideration the liquid sources of the borrowers, the net liquid sources of the borrowers. Net liquid sources are the liquid sources. Advance is granted only based on 3 C's of the borrower, viz. Character, capacity and capital. In this type of advance, banks insist on personal guarantee of the borrower. Loans granted without any security for a short period only based on the net liquid resources of the borrower are called clean loans. Banks consider always the 3 C's, character, capacity and capital, before advancing clean loans. Besides, personal guarantees of the borrower and third parties are also given the weightage while granting clean advances. So that these are very important and significant advances among all the advances. With 3 C's, all these are considered. Right. This is clean advance and essentially unsecured advance. Banker extends credit facility for a short period only. Let's see another form of lending, that's a temporary overdraft or temporary overdrafts. These are unsecured over granted by bankers for small amounts to customers having current accounts with them. The facility is provided to salaried officials or persons engaged in trade or industry. It is limited to the expected monthly cash flow of the borrower. Temporary overdrafts are granted against reliable source of funds available to a borrower for yearly The granting of temporary overdraft facility will depend on the continuity of the service of the employee. The strict control is exercised over such advances. Prior sanction from the usually required for sanctioning such temporary overdrafts, unless otherwise it will not be sanctioned. Or prior sanction from the authorities that should be obtained. It is required for sanctioning such overdrafts to the borrowers. Let's see the next type ones is that term loans. What do you understand by term loans? The loans that are granted for a certain period of time are known as term loans. The term loans are usually provided for medium and long term and are repayable in installments. They are granted for meeting the various purposes of industries over a number of years, ranging from 3 to 10 and sometimes more. The period of the loan is arrived at on the basis of the estimated future earnings and or cash flow of the borrower. Term loans are custom designed to meet the borrower's needs for credit and satisfy the lending bank's requirements, lending banks, which is the bank which is lending now, and their requirements, satisfy their requirements for earning, liquidity and safety. Earning does mean the profitability, liquidity does mean the cash liquidable always, and the safety, liquidity from the assets and properties pledged with the banker could be liquidated, and safety for their lending. These are all the satisfaction in the point of view of a lending bank. These are provided for medium and long term and are repayable in installments. Understand? Of lending is the participation loans. That's what we are going to see now. When two or more banks agree to advance a large term loan jointly to the borrower in a certain agreed proportion against a common security, such loans are called participation loans. Banks agree to advance a particular customer jointly to the customer, jointly called participation loans, or consortium finance. It may otherwise be known as consortium finance. They are also called consortium advances. The proportion of each of the participating banks is decided of the consortium. Such loans are extended to meet large sized credit requirements of trade and industrial housing. This is one of the form of lending. Let's see another form that continues. Demand loans. Loans that have no stated maturity period are such loans are to be repaid on demand. A distinct feature of this type of loan is that pays the borrower the entire amount of the loan sanctioned. The type of security for this loan include personal security of the borrower, besides shares, debentures, government papers, immovable receipts, life insurance policies, goods, etc. Interest is charged on the according to the intervals agreed to by the parties. So debit balance according to the intervals, which will be taken for the calculation of interest and will be noticed, which will be agreed by the parties that one is to pay and the other is to get back. So loans, one form of lending. Let's go for another form, which is now available and which is now shared, and those who are affected mostly called housing loans. An important foreign banker is housing finance. Everybody is doing housing finance today. Housing loans constitute deployment of funds by a banker. In fact, a substantial portion of the earnings of a bank emanates from the housing finance activities undertaken by a bank. It is by all bankers, including a modern banker today. The another form, which is continuing now, which we are going to see, the loans to small borrowers. loans to small borrowers. To small borrowers such as the common man and self-employed persons, say doctors, etc. Banks under the umbrella of social sector lending advance or under the banner of social sector lending. They advance such kind of loans to the people or self-employed people, professionals and all. The purpose of granting such loans is to help the sections and weaker sectors of the economy to improve their living standards, to uphold the livelihoods of each and every individual. These advances are made by loans are granted on the strength of borrowers' credit and their worthiness, credit worthiness and capacity. Only on the strength of or on the basis of the borrower's credit worthiness and the capacity to repay. These are all the points that are considered for granting the loans to small borrowers. Lending is, next form of lending is hire purchase and leasing finance. Hire purchase and finance. Hire purchase finance that takes the form of advances granted to parties to finance relating to transport vehicles, machinery and durable consumer goods. Example, refrigerators, washing machine, etc. Banks have also started lending. Similarly, banks also provide financial facility to lease finance companies in order to enable give assets on lease basis. Another form of lending is discounting. Bill discounting constitutes another important type of lending. Banks discount genuine commercial and treasury bills. Loan amount constitutes the fee of the bill minus the discount charges. Discount constitutes the income earned by the bank. In these bills is generally referred to as the third line of defense for the banks. The money lent on or before the bill period. A strong bill market is required for a strong and a healthy money. Bills are of bills and documentary bills. Clean bills have no documents accompanying them, whereas the necessary and required documents of title to goods such as railway receipts or bills of lading, bill of lading. Bank provides assistance and the genuineness of the bills drawn by the trader. The financial standing of the drawee, both in respect of bills purchased and discounts, the bills till the maturity date of the bill. On the stipulated date of maturity, back the bills of exchange originally deposited by the trader. The drawee failing to make payment, the drawer has to make the bill. However, the banker takes into account the financial position, integrity of the drawers, makers before discounting. This is what the principle of doing, and this is one form of lending which bank treasury bills. Let's go for another form of which is known as packing credit. What? A short-term credit granted by a bank assists him to buy, process, pack and ship the good. Packing credit. It is advanced for a period of not. The advance is liquidated either by negotiation, export bills covering the particular shipment for which the packing credit is granted, and it is relevant to export trust receipt. Packing credit is granted against export trust receipt (ETR). Is the receipt executed by the exporter borrower. The borrower declares that the goods purchased by him with the bank in trust for the bank, either on a pledge basis, the goods to be exported remain in the possession of the bank, or its approved clearing agent. The documents of title of goods such as marine insurance, shipping documents are lodged with the bank. Packing credit is adjusted to the export proceeds receivable by the buyer, exporter, buyer of the money here, buyer not meant as here, buyer, the money buyer, borrower, exporter. Credit is extended either on hypothecation basis the goods to the borrower. In case of hypothecation, for the shipment of goods and delivers to the bank the entire documents for negotiation under the letter of credit for purchase. The advance is liquidated by negotiation covering the shipment of goods. These are the conditions which are relevant to export. Right? This is packing credit, which will be availed by the export. And the next term or next form of lending is import finance. It includes related activities. Import financing include finance for import, settlement, delivery of imported goods, and import usance bills, etc. For which, or this is the fund which can be or which will be provided for their import relevant activities, imported related activities, or import connected activities. The 14 packing credit and 15 import finance are related to the export. And the very next is consumer credit. It is another form. We are going to wind up the forms of lending seeing this. Consumer bank credit normally granted to consumers for their personal needs of cars, refrigerators, television set, repairing of houses, reconstruction of houses, settlement of hospital bills, etc. Such loans are advanced to respectable customers and are within a couple of years, 2 years, 3 years, or maximum 5 years. These loans are also called loans. Under the 20-point economic program, the scope of was extended to cover marriages, funeral, final rites to the deceased, and associated religious ceremonies, etc. The amount is given in a lump sum and is repaid within a couple of years. These are all, and you must understand how the bank deals all those things, customers of those kinds of or those forms of the loans. And the next topic is to see the loan evaluation, to understand how the loan applications are received by the next. How is it evaluated? How is it analyzed? These are all the things you should know at this juncture under the head process. The lenders, such as banks and financial institutions, some of the mind while doing the loan evaluation application process. While granting loans and advances, they have to be very careful doing those things. That's what we are going to see under loan evaluation process. The lenders, such as banks and financial institutions, should adopt the following loan evaluation process while granting loans and advances. What are they? I am going to say you, please follow the process of loan evaluation. One is pre-screening of loan application. The first and the foremost step in the loan evaluation process is to screen the application for loan to check for the basic aspects concerning the purpose. For instance, for a typical business loan, it is advised that banks verify the details such as nature of business, business plan, estimated future revenue, etc. to get an understanding of the purpose for which the loan is sought for, the loan is applied for. So pre-screening of loan application will say that the application is to be scrutinized and the purpose should be determined for which it has been applied so far. The second stage in the loan evaluation process is checking past track record. Immediately after pre-screening the loan application, the bank has to carry out the necessary check to find out whether the borrower has maintained a good track record with regard to the servicing of loan. The purpose of this step is to eliminate the chances of fraud, misappropriation, etc. The fraud, misappropriation, fraudulent transactions, or any kind of such mistakes that should be found out to find out the track record. And this is under the process of checking past track record. Today is the CIBIL score that has been saying about the customer whether he is credible or not, right? Then the third process in the loan evaluation is analyzing the credit report. A credit report contains the details of all the credit facilities that has been availed by the borrower, and also the credit details where the borrower had lent his name as a guarantor or co-applicant. A thorough analysis of the credit report of the borrower is carried out by the lender in order to determine the past payment history to ensure that there is no default or delayed payments. To know the type of credit mix, that is fund based or non-fund based, whatever it is, but a thorough analysis of the credit record of the borrower or the customer is to be done. And the fund based or non-fund based proportion of own liability borne as a guarantor, etc. The ultimate purpose of this step is to enable the lender to assess the repaying capacity of the borrower. Lender will assess the repaying capacity of the borrower. Of course, the repayment capacity of the borrower failed or found guilty, the lender will not go for lending to the particular borrower. Otherwise, the lending will become the overdue at once after some time and will not be repaid and will become the non-performing asset, as well as the overdue that becomes bad at one stage. So that analyze the credit report is another stage or step process in the loan application evaluation. Next is analyzing the financial statements. The lender should make a detailed study of the financial statements of the borrower. An analysis of the balance sheet would reveal the important parameters of the borrower's financial strength of the borrowers. The lender has to carry out ratio analysis, including liquidity ratio, solvency ratio, etc., and also the debt to equity ratio, right? Besides making comparative balance sheet analysis. So he has to do some ratio application, by means of which he has to find out the ratio. The lender has to find out the ratio. Then he may go for the lending and also the sanctioning of loan. These are all the loan evaluation process by which the lenders like banks and financial institutions should adopt the methodical approach like this to evaluate the loan application of each and every applicant while granting loans and advances, right? And one more, the loan evaluation process is physical verification of assets that can also be included in the evaluation process. As a last part of the loan evaluation process, the lender should conduct a physical verification of the business premises and other details of fixed assets owned by the borrower. The purpose of this process is to establish the collateral capacity of the borrower. Whether the borrower has the collateral capacity or not will be found out applying the physical verification of the assets. This is also another process in the loan evaluation. All money lenders must do all these 5 stages while lending to an applicant, carefully seeing all the details from the application level to the physical verification of assets, so that they'll be able to do properly and sustain the customer also, right? These are all the loan evaluation process. Hope you would have understood. The next topic is that securities for lending. What are all the securities required to be pledged with the bank for lending purpose? Let's see one by one. Before that, I would like to say about the securities for lending. Without the securities, no lending. Without accepting the securities, no lending would be possible. As a prudent lending policy, bankers always advance loans against some security or the other. The nature and the kind of security are broadly classified into 2 categories, such as personal security and collateral security. Collateral, some people say collateral. A detailed description of these securities are to be discussed, and these securities are to be obtained for lending purpose. In viewpoint of banker, I am saying, first of all, we need to understand what is personal security, right? Personal security constitutes the acquaintance, guarantee, and personal security of the borrower in securing the loan from a bank. Loans advanced under this category are called clean loans. In this type of security, bankers do not virtually insist on any security at all. Good faith of the banker is the foundation on which loans are granted. Accordingly, loans are provided usually to respectable customers with whom it is well acquainted or in whose integrity it has full faith. Since there is no security for this type of loans, the banker needs to exercise utmost caution in executing the loan. In the Indian context, loans are generally granted against personal security of two types, viz. One party pro note, promissory note, and two party pro note. Under the one party pro note, a loan is granted to the party against a pro note executed by it, promissory note. In the case of the two party pro note, a loan is given with the borrower and the surety jointly executing the pro note. Surety or the guarantor's guarantee. It will be obtained. So based on that guarantee alone, the personal securities are obtained by the banker for granting loans in some cases. Let's go for the next security, known as collateral security. Collateral may consist of a variety of assets such as real estate, goods like raw materials as well as finished goods, warehouse receipts, share certificates, negotiable bills of lading, etc. The basic requirement of such assets is their marketability. And there should be a marketable value for those assets which are going to be obtained as collateral. The main objective of a bank requesting for security is to reduce its risk of loss in the event of the failure of the borrower to pay the loan at maturity. Right? In the case of unsecured loans, the borrower does not give any security to the banker. Credit is based upon the integrity of the borrower, upon his record of payment, upon income generated over a given period of time, and the information presented by the borrower in his financial statements, his record of accomplishments and operations, the borrower's legal promise to pay, promissory note, serves as a security for unsecured loan. Collateral security constitutes physical securities executed by the borrower in favor of the banker before advancing loans. Physical securities include tangible assets, both movable and immovable. Movable assets include inventory of goods, etc. Immovable assets include land, buildings, plant and machinery, etc. The borrower executes the collateral securities in any one of the following ways. What are they? Let's see one by one. One is hypothecation, two is pledge, and three is mortgage. What is hypothecation? Under hypothecation, loans are granted on the strength of movable assets like inventory of finished goods or inventory of raw materials, delivery van, or any kind of asset, etc. The securities remain under the custody of the borrower. The documents of title to those assets are however handed over to the lender or banker or the financial institution where from the customer is obtaining loan, and which remain under the custody of the banker. The documents are returned to the borrower only after the due repayment of the complete loan. Once he completed the loan settlement, loan repayment, it will be handed over again back to the customer. And pledge, what is pledge? In the case of pledge, banker grants loans against valuables such as jewelry, etc. and the security goes into the custody of the banker and is released to the borrower upon the repayment of the loan. The title to the valuables, however, remains with the borrower, but in the event of the default committed by the borrower, the banker would auction the valuables and can compensate itself with the proceeds accruing from the auction. The next is mortgage. In the case of mortgage, loans are advanced against the security of immovable assets such as land and buildings, plant and machinery, etc. No transfer of assets from the borrower to the banker happens. The documents of title to such assets is, however, transferred to the banker and remain in the banker's custody till the repayment of the loan. In the event of the non-repayment of the loan, the ownership of the mortgaged property automatically gets transferred to the bank. Property can also be attached which would prohibit the borrower from dealing with the property in any manner. Let's see the types of collateral securities. Bankers accept different types of securities for advancing loans to customers. Such important collateral securities are stock exchange securities, goods and titles to goods, bills of exchange, life insurance policy, and property. These are all to be discussed. What are they actually, and what are the procedures in getting those collateral securities, right? We need to understand then personal security, the collateral security in full. So we will continue the discussion on the collateral securities, particularly with all fundamentals and also the nuances, and we articulate how the collateral securities are pledged with the banker and all are collected from the customer by bank in the next session. Wish all the best.